In this lecture, we're going to talk about Chapter 5, Interest Rates and Bond Valuations. The concepts to know the important features of bonds and the bond types. Understand why bonds behave the way they do. And we're going to talk a little bit about bond ratings and understanding how inflation affects interest rates and the structure of interest rates and determinants of bond yields. The chapter outline I view as somewhat of a useless slide, but there it is. First of all, bonds are a legally binding contract between a borrower and a lender. A bond is a promise by a borrower to pay back the par or face value. And I'll just say right now in this class we're going to assume that the par or face value is always $1,000 unless otherwise stated. The coupon rate is the contractual rate of interest of the debt, and it will be stated in the contract. The coupon payment would be the coupon rate times the par or face value. That's the amount that is paid per year, the coupon payment. Sometimes paid semi-annually, sometimes paid quarterly. Some bonds even pay monthly, but usually semi-annual. And the maturity date is the date when this debt contract actually expires, and that's the point in time at which the par or face value is due. The yield to maturity is the rate of return that makes the coupon payments equal to the price of the bond. If you discount the future value, the present value of the, excuse me, if you find the present value of the coupon payments. So the primary principle of a bond is essentially a stream of cash flows, and its value is the present value of its expected future cash flows. It's determined by the present value of an annuity in the form of coupon payments and the present value of a future lump sum called the par value. And in general, bond prices move down as interest rates move up and vice versa. The bond pricing equation really consists of the addition of two terms. The first is the present value of an ordinary annuity, and the second is the present value of the face or future value of the bond, and usually that F in that equation is $1,000. So we'll look at some examples. Here's an example of a U.S. government bond. You may be aware that the U.S. government sells lots and lots of bonds. This one has a 6 3/8% coupon and expires in December of 2009. The par value is $1,000. As I said, we will always assume $1,000. Coupon payments are made semi-annually on June 30th and December 31st for this bond. And so what we do to find the coupon payment is we take the coupon rate, 6 3/8%. We divide it by 2 to get a 6-month rate, and then we apply that 6-month rate to the $1,000 face value. We get a $31.87.5 coupon payment every 6 months. And on January 1st, 2005, this is what we're looking at. So we have a series of payments of $31.875 each 6 months up until December 31st of 2009, at which time, notice we get the $31.875 plus the $1,000 face value. Actually, at this point, before I even go any further, I'm going to go to a spreadsheet, and I'm going to put, I'm just going to put this stuff in and show you. If we find the present value of the bond, and the rate is 6 3/75 divided by 2, and the number of periods, let's just think about this, from 2005 to 2009, 5, 6, 7, 8, 9 would be 5 times 2 is 10, I believe. And the payment would be, we'll take the, let's see, well, I'm getting a little ahead of myself because they haven't given us a rate yet, so let's keep going here. The yield is 5%, so let's go back and do this again. The yield will be 0.05 divided by 2. The number of periods will be 10. The payment will be 0.06375 divided by 2 times 1,000. And the future value will be 1,000. And if we put those in, we'll get the value of this bond, $1,060.17. So let's try that. In this case, they have put the numbers into an equation, and there's the $1,060.17. So the discount rate is 0.05 divided by 2. The coupon payment is the $31.875, and the $1,000 is the future value. Okay. I did this on a spreadsheet. If you want to do it on a calculator, here's an example of how you would do that. Now let's assume that the required yield on this bond becomes 11% instead of 5%. Now in this case, I can very easily, and this is one of the nice things about a spreadsheet, I can just go into my original equation and change that 5% to 11, and I'm done. So that's very simple. If you're doing this on a financial calculator or you're doing this with formulas, you're going to have to stick all the numbers in again and redo all the calculations. And this time you get 825.69. There it is, 825.69. Okay, now this slide illustrates the inverse relation between bond prices and yield to maturity. And notice that as the yield to maturity increases down here on the x-axis, the bond price, the bond value, decreases. So we have a negative sloping line. And also notice that right here, where the discount rate equals the coupon rate, the bond is equal to $1,000. And that will always be true. It will always be true that whenever the discount rate equals the coupon rate, the bond will have a present value equal to its par. Some basic bond concepts. Bond prices and market rates move in opposite directions. We've already pointed that out in the previous slide. And when the coupon rate equals the yield to maturity, the bond price equals the par value, or in our example, $1,000. And when the coupon rate is greater than the yield to maturity, the price is greater than par, and that's called a premium bond. And if the coupon rate is less than the yield to maturity, the price is less than par, and that's called a discount bond. Interest rate risk really consists of two parts. Price risk, which occurs when the price of a bond changes because of interest rates. And generally it depends on whether you're trying to buy the bond or whether you're selling the bond. But if you own the bond and interest rates go up, the price of the bond will go down, and you will have lost money. The value of the asset that you hold will decline. Long-term bonds have more price risk than short-term bonds. So if interest rates go up on two bonds, one's long-term, one's short-term, the long-term bond will move more. Lower coupon rate bonds have more price risk than high coupon rate bonds. And then we have reinvestment risk. And reinvestment risk, here's the problem with bonds. When you buy a bond, every 6 months or every year, you're going to get a coupon payment, and you have to do something with those coupon payments. If you just take them and spend them, you will not get the yield to maturity that you expected. So you're going to have to reinvest them. And if after you buy the bond, interest rates go down, you're going to have trouble reinvesting the coupon payments at a rate that's big enough. So this is uncertainty concerning the rate at which cash flows can be reinvested. And short-term bonds have more reinvestment rate risk than long-term bonds. And high coupon rate bonds have more reinvestment rate risk than low coupon bonds. That makes sense. If somebody hands you a bigger coupon payment, you've got a bigger reinvestment problem. Here's an example that illustrates the relationship between maturity and bond prices for two otherwise identical bonds, but one's a short-term bond and one's a long-term bond. And notice the short maturity bond, first of all, notice that both bonds' values decline as interest rates, as the discount rate increases. But notice that the short maturity bond has less movement, less up and down movement, so it's less sensitive. The bond price, the bond value is less sensitive to discount rate movements than is the long maturity bond. Also, we can look at the relation between coupon rates and bond prices. And so the red line shows us a high coupon bond, and the dark line shows us a low coupon bond. And notice again that the high coupon bond is a little flatter, the line, meaning that it's a little less sensitive to movements in discount rates. For a given change in discount rates, the low coupon bond will move up or down more than the high coupon bond will. Computing yield to maturity on a bond, generally if we're doing this with a financial calculator, we would calculate the interest rate, or if we're doing this with a spreadsheet, we'll use the rate function. But the yield to maturity is a rate that makes the present value of the promised payments equal to the price of the bond. And we find the yield to maturity, as I said, by using, I'm going to use the rate function on Excel. So let's get to an example. Here's a bond with 10% annual coupon rate, 15 years to maturity, a par value of 1,000, and the current price is $928.09. So what I want to do is I want to find a rate that makes the present value of the coupon payments plus the future value equal to $928.09. So let me go back to our spreadsheet, and I'm going to use the rate function. And the first thing that goes in is the number of periods, and this is a 15-year bond. And the next thing that goes in is the payment, and this is a 10% bond, so we'll take 10% times 1,000. And the next thing that goes in is the present value, and in this case the present value is $928.09. Now when you do rate, 928.09, you always need a sign change. And in general what I recommend is that you think of, you just try to be consistent in terms of your perspective. If you're an investor, you can think of the coupon payments as being cash flows to you, so they're positive. You can think of the price you paid as being a price going out of your checkbook, or a negative amount. The future value here is going to be 1,000. So notice I have a positive and then a negative and then a positive. If you don't get the signs right, you're going to get the wrong answer. In this case, 11%. And I've cautioned you before, whenever you get an interest rate, you want to always make sure that you look at more decimal places. In this case, it works out to exactly 11%. But question, will the yield be more or less than 10%? Now here's what you realize. You realize that if the rate were 10%, if the coupon rate and the discount rate were equal, this bond would sell for $1,000. You also realize that as rates go up, prices go down. So we look at this price, $928.09. It's less than 1,000, so the price has gone down, so the rate has gone up, and therefore the rate will be higher than 10%. We can put these in the financial calculator, compute, and there it is, 11% yield to maturity. Now if we have semi-annual coupons, the process is exactly the same for a spreadsheet. So here's a 10% coupon rate, semi-annual coupons, face value of 1,000, 20 years to maturity, and it's selling for $1197.93. I can go back to my original problem and just 20 years to maturity. Now this time what we have to do is we have to work with periods. So since it's semi-annual, we're going to get 20 times 2 6-month periods. And the coupon rate is 10%, so that will be the same, except we want to divide it by 2 because now we're going to get it every 6 months, half of the payment every 6 months. The payment, $1197.93, so let's just put that in, $1197.93, and the future value is 1,000. And then the other thing I'm going to have to do here, this is going to give me a 6-month rate, so I need to multiply by 2. And the answer is 8%. So let's go back and, again, just for purposes of thinking about this, realize that this is a premium bond. The price is more than 1,000, so the coupon is going to be less than 10%. And we already know the answer is 8%. And semi-annual coupon payment will be $50, 10% of 1,000 divided by 2, or 100 divided by 2. And how many periods are there? There will be 40 periods, 20 years, 40 periods. And if you put this in your calculator, notice you get a yield of 4, and that's a 6-month yield, so we have to multiply by 2, and we get a yield to maturity of 8%. Okay, now we're going to talk about something that's a little simpler than yield to maturity, and that's current yield. Current yield, by definition, is just the annual coupon payment divided by the price of the bond. And there is an equation that's useful, and it says that the yield to maturity, which we've just calculated a couple of examples of, is equal to the current yield plus the capital gain yield. Now, let me just talk to you a minute about capital gain yield. If you have a premium bond, a bond selling for more than $1,000, if everything else stays the same, then over time, the price of that bond is going to work its way down to $1,000, because when that bond matures, it's worth $1,000. If you have a discount bond, the exact opposite is going to happen, and the bond price is going to work its way up to $1,000. So if you have a premium bond, you're actually going to have a capital loss, and if you have a discount bond, you're going to have a capital gain. So let's look at an example here. Here's a 10% coupon bond, semi-annual coupons, face value of $1,000, 20 years to maturity, and $1197.93. Now that's the bond that we just got through working, and we know that the yield to maturity is 8%. We already know the answer. So let's look at this calculation. First of all, the current yield is, if you look up above, the annual coupon divided by the price is 100 divided by 1197.93, or 0.0835 or 8.35%. Now, if we go back to this bond, and let me do this, what would the bond be worth in 1 year? Well, the bond is worth the present value of its future payments, and the interest rate that we're using is 8% divided by 2, so 4% per period. And if it had 20 years before, which is 40 payments, now it must have 19 years or 38 payments. And the payment is going to be 50, and the future value 1,000. Notice that both of those are the same sign, and the bond is going to be worth $11.93. Now the bond was worth $1197.93. I'll just write that, $1197.93. So what we actually have done, I'll just format that as dollars, I guess. What we've actually done is gone from $1197.83 down to $1193.86. So that's a capital loss. And how big is it? What percent is it? Well, if we take the price at time 1 and divide by the price at time 0 and subtract 1, we see that what we actually did is we lost, and let me turn that into a percent also, and look at a few more decimal places. What you see is that we actually lost 0.35%. All right, now, so there's the capital gain loss, and it's a loss because we have a premium bond. So if we take the current yield of 8.35% and add the capital loss, which in this case minus 0.35, we get the yield to maturity of 8%, which is exactly the yield to maturity that we calculated earlier. So one way to calculate the yield to maturity is to take the, to find a rate that makes the price of a bond equal to the present value of its payments and its future value. Another way is to look at the sum of the current yield and the capital gain yield, depending on which information you've been given. This can also be very useful to help you think about, well, am I in the ballpark here? For example, I know that in this case, since this is a premium bond, I know that the yield to maturity has to actually be greater than the current yield, or at least, less than the current yield. So if you have a premium bond, the yield to maturity is always going to be less than the current yield. If you have a discount bond, the yield to maturity is going to be greater than the current yield. So that gives you another kind of just a mental check to see where the price of the bond is, where the yield is. Some bond pricing theorems. This will turn out to be important not only for bonds but for other kinds of assets. Bonds or any asset of similar risk and maturity will be priced to yield the same return, regardless of the coupon rate. If you know the price of one bond, you can estimate its yield to maturity. You can use that to find the price of the second bond. And you'll have some problems in your homework that ask you to do that. And that, as I said, is a concept that can be transferred to other places. For instance, it's used often in valuing corporations. If you have one corporation that's publicly traded and you have another one that's not, you can use the value of a very similar publicly traded corporation and use that to estimate the value of the non-traded corporation. Okay, I'm going to skip over price and yield. I don't recommend that you try to use those for our class, but if you want to, you can look through them. There's a spreadsheet example here that you can look at. Let's look at debt versus equity. Now remember, corporate bonds are a form of debt and stocks are a form of equity. Stocks are ownership. So debt is not an ownership interest. Debt is a legitimate business expense. Creditors don't have voting rights. However, they do have legal rights, and if the creditors are not paid, they can force the company into bankruptcy and take over the company from the stockholders. Interest is considered a cost of doing business, and therefore it's tax deductible. Creditors have legal recourse if the interest and principal payments are missed. So debt is not something that the management or stockholders of the company have an option to just ignore. They have to be paid. Debt holders have to be paid. Excess debt can lead to financial distress and bankruptcy, and I want to emphasize that point. I can't think of any single thing that companies do that gets them into more trouble than having excess debt. Over and over you see companies that are bankrupt, they get too much debt. General Motors, a good example. General Motors had more debt than their entire assets were worth. On the other hand, equity is an ownership interest. Common stockholders do have a right to vote on the board of directors and on other important issues. And dividends are not considered a cost of doing business, and therefore they're not tax deductible. Dividends are not a liability of the firm. If the board of directors, which is the group that declares dividends, decides to skip them, they're certainly within their legal rights to do that, and stockholders have no legal recourse to force dividends to be paid. An all-equity firm can't be forced into bankruptcy because of failure to pay dividends. Certainly can for failure to pay interest or principal. Now, the document that summarizes the legal obligations of the debt holder and the rights of the rights of the debt holder, the legal obligations of the firm, is called a bond indenture. It is the contract between the company and the bondholders. It includes the basic terms of the bond as well as the total amount of bonds issued. If there's any security that's being pledged as collateral, that's described. And most bonds have a sinking fund provision. And what that is a special fund where interest is paid periodically on bonds and principal is paid. And that principal is set aside so that when the bonds mature, the money will be there to retire the bond principal. You can imagine, for instance, if a company like Ford Motor Company issues $500 million worth of bonds, we don't want to have to wait 50 years and then find out that the company doesn't have the $500 million. Call provisions are provisions that allow the bondholders to, that allow the corporation to call the bond, or in other words say, look, we want the bond back, we're going to pay you a certain amount and we're going to take the bond away from you. And then bonds have protective covenants, and there are two kinds. There are restrictive covenants and there are affirmative covenants. Just what it sounds like. Restrictive covenants tell the company what it can't do, and affirmative covenants tell the company what it has to do. Bond classifications, registered versus bearer. Registered bonds, actually there is a document somewhere that has your name on it, says you're the owner of the bond. If the bond is lost or stolen, the person who stole it can't use it, you would be able to get it back. Think of a registered bond as being similar to a traveler's check. If you have the receipt and you lose the traveler's check or it's stolen, you can get a replacement for the traveler's check. Bearer bonds, on the other hand, are, if you have them, they're yours. So if you watch Die Hard with Bruce Willis, when they were breaking into the vault in the Nagasaki building and taking those bonds, they were bearer bonds, and whoever owned them had them. Same thing with the movie The Safe Room, Jodie Foster. Security. Bonds can be provided security or collateral, which is security for the securities, and usually that's in the form of property, real estate, or something like that. Often there's a mortgage, which is the security document that says, look, if the bond isn't paid, then the security can be seized and sold, the land and buildings can be sold, and the money can be used to pay off the bondholders. A debenture is just a name. Don't get that confused with indenture. A debenture is a name for an unsecured bond. There is no security. A note is just an unsecured bond, a debenture if you will, that has an original maturity of less than 10 years. And then bonds can be either senior or junior. Just what it sounds like, a junior bond gets paid after the senior debt holders are paid. The required yields, the coupon rate depends on the risk characteristics of the bond at the time it's issued. And you can think about these things. Which of these will have a higher coupon? A secured debt or an unsecured debt or a debenture? The way to think about these is to think about risk. From the lender's point of view or from the borrower's point of view, but let's think about it from the investor's point of view. From an investor's point of view, if the debt is secured, then they have assets. And so just like a car loan, the rate should be lower on secured debt. So the yield will be, the coupon will be lower on secured debt. Subordinated debentures will be more risky than senior debt, and therefore subordinated debentures will have a higher rate. A bond with a sinking fund will be safer than one without, so it will have a lower interest rate. And a callable bond presents more risk to the investor, and so it will have a higher rate. Now, we talk about bond ratings, and generally there are 3 companies right now that provide bond ratings, 3 major companies. There are actually 5 companies, but the 3 major are Moody's and Standard & Poor's and Fitch's. Moody's and Standard & Poor's are United States companies, and Fitch's is more of an international rating agency. But bonds are rated generally high grade, AAA, means the capacity to pay is extremely strong, the balance sheet is strong, company has plenty of assets, plenty of cash flow. AA, capacity to pay is still strong, very strong. And then medium grade, rated A or BAA, or in the case of Standard & Poor's BBB, the capacity to pay is adequate but not outstanding. In general, as the rating grade goes down, the required yield to maturity on the bond goes up because the bonds are riskier. So the less strong the bond, the higher the rate the company has to pay to induce investors to buy this bond. If we get into more speculative, we get both a low grade and very low grade, which really comes under the category of junk. Now, I want to say one thing about the bond ratings. Bond rating agencies have come under tremendous attack recently because of the great the financial collapses we had, and the argument is that the rating agencies failed to do their jobs, they failed to give investors a heads up, they failed to warn investors of the actual risk in the bonds, investors bought these bonds, and then when things went bad, the bond rating agencies rushed in and lowered the rating, kind of like closing the barn door after the horse is out. So Congress has been after these rating agencies, they're under attack, and there's a pretty good chance that this whole system will be revised. So don't get too attached to this system, but that's what it is right now. The U.S. government probably is the single largest issuer of bonds. The Treasury Department funds the deficit, our federal deficit, with bonds, and it is huge. And many foreign countries like China are some of the major buyers of our debt. Treasury bills are pure discount bonds with an original maturity less than 1 year. Notice that's an original maturity. I told you earlier that a note is a bond that has an original maturity of less than 10 years. Well, a note doesn't automatically turn into a T-bill when it goes to a maturity of less than a year. Once a note, always a note. Treasury notes is a coupon debt with an original maturity between 1 and 10 years, and then Treasury bonds have a coupon debt with original maturity greater than 10 years, and usually 30 years. The long bond, the long Treasury bond, is a 30-year bond. Although the government has experimented with other kinds of bonds, the British government issued consols, which actually don't have a maturity date. They're essentially perpetuities. And then we have municipal securities, and these are securities issued by state and local agencies, even cities, and basically there's varying degrees of default risk, and these entities are rated because they can default. If you think about the U.S. Treasury, they have the power to print money. So technically they can't default, although you could question the value of the dollars you're paid with. If the government has to print too much money, the value of the dollars may decline. You know, excess supply. When you have too much supply of something, the value of it goes down. But state governments can't print money. They have to balance their budgets. They can't run deficits. And if they can't pay the debt, you can have a default. And there have been some very well-known defaults of state securities. Washington Public Utilities had one a few years back. They call it Whoops. Okay, generally, because of the separation of the federal government and the state governments, the federal government does not tax state income, and the state government does not tax federal income. So interest received on municipal securities is generally, and I say generally, exempt from federal tax because there are specific rules. We talk about an after-tax yield. Obviously, if you're an investor and you have to pay tax on your coupon payments, they're not going to be worth as much as if you didn't have to pay tax on those same payments. So since a municipal bond, when you get a coupon payment from a municipal bond, you don't have to pay tax, it's worth more. If you get if you get a coupon payment from a corporation, you have to pay tax on it. So here's a taxable bond that has a yield of 8% and a municipal bond that has a yield of 6%, and we'd like to compare them to see which has a higher rate of return. Now your first reaction is obvious. 8% is higher than 6%. But the question is, since I have to pay tax on the 8% bond, do I really get 8%? And that really depends on your tax bracket. So suppose you're in a 40% tax bracket. Which bond would you prefer? Well, if I get the 8%, I'm going to have to take out essentially 40% of the return, and I'm only going to get an effective return of 4.8%. Whereas if I take the municipal bond, I'm going to get the whole 6%, get to keep it. So really, the municipal bond has a higher yield for a 40% taxpayer than the corporate bond would. Now, whether you would prefer one or the other would really depend on which tax bracket you were in. You could ask, well, is there a tax rate at which I wouldn't care, at which I would be indifferent between the 8% bond and the 6% bond? Well, up there, if you put a T where that 0.4 is, and instead of 4.8, you set that equal to 6 and solve like this, you will find that if your tax rate is 25%, you wouldn't care. And if your tax rate is greater than 25%, you'd rather have the municipal bond. And if your tax rate is less than 25%, you'd rather have the corporate bond. So there are real clienteles, and they're determined by the tax rate of the individuals. Some clients prefer corporate bonds, some clients prefer municipal bonds. Now, one of the most important categories of bonds is a zero coupon bond. Here's what makes zero coupon bonds attractive. Well, first of all, they're called zero coupon rates bonds for the obvious reason. The coupon rate is zero. There is no coupon payment. So the only cash flow that you're going to get is the par or face value when the bond matures and nothing in between. Now what makes these things so attractive? Well, in a nutshell, there's no reinvestment risk. You don't have to worry about getting those coupon payments every 6 months and figuring out where to invest them. So the entire yield is going to come from the difference between the purchase price and the par value. And these bonds are called discount bonds, sometimes called deep discount bonds, because they sell for very low prices relative to the $1,000 face value that you're going to receive, and they can never sell for more than their par value. So a $1,000 bond could never sell for more than $1,000. Sometimes they're called zeros, sometimes called deep discount bonds, sometimes called original issue discount bonds. It is possible, the Treasury itself doesn't actually issue zero coupon bonds, but creative people on Wall Street have figured out how to strip the various payments off Treasuries and repackage them and sell them as zero coupon bonds. So for instance, the coupon that you're going to get in 1 year can be a 1-year zero coupon bond. The coupon in 2 years can be a two-year zero coupon bond, and so on. You just have to get enough of those. Pure discount bonds, all you really have then are 3 variables. You have the time to maturity, the face value, and the discount rate. And that's what things look like. All of the coupon payments are zero, and you have that F in the front. And the value of that thing is just, the annuity's gone, and all you have is the present value of that future face value. Here's an example. Excuse me. Find the value of a 30-year zero coupon bond with a $1,000 par value and a yield to maturity of 6%. Now, if you were doing this on a spreadsheet, you would just say, well, look, I just want the present value, and the rate is going to be, well, let's see, 6%, and we're going to have 30 years, and there's no payment, so I'm just going to skip it and have 1,000 for a future value. And you'd say, well, this bond sells for $174. So here's the deal. Go out and pay $174.11, wait 30 years, and get your $1,000. And in the meantime, you don't have to do anything. You don't have to collect any cash flows. You don't have to reinvest any cash flows. You just sit and wait. And the reason it's called a deep discount bond is because you can see, you can buy $1,000 for $174. Of course, it's $1,000 30 years from now. But there it is, and if we put it in the formula, we get the same thing. Now, floating rate bond is kind of like an adjustable rate mortgage, or it's like your credit card, where the credit card company's always changing the rate depending on whether the prime rate or whatever you're indexed to goes up or down. Anyway, the coupon rate floats depending on some index, and it could be anything. I mean, the only limit is your imagination. Adjustable rate mortgages and inflation-linked securities are examples of floating rate bonds. There's less risk to the borrower from a floating rate bond because they don't have interest rate risk. Well, look at it this way. The purchaser of the bond, what happens if interest rates go up? Well, you get a bigger coupon payment. And if you get a bigger coupon payment, the price of your bond went down, but your coupon payment went up. So the two things offset each other. What if interest rates go up, go down? Well, if they go down, the price of your bond goes up, and yeah, your coupon payments go down, but again, the two offset each other. So these bonds are less risky to you, and they're a little more stable. So the coupon floats, less likely to differ substantially from their yield to maturity, and the coupons could have a collar. And this is typical of adjustable rate mortgages and all kinds of variable rate securities. A collar just limits the amount the rate can go up or down. If it's a limit on how far it can go up, it's called a ceiling, otherwise called a floor. Some other types of bonds, income bonds. An income bond is a bond that is paid out of the income from a project. So if the project fails to earn an income, you take that risk. As a purchaser of an income bond, you agree that if the project is successful, you get paid, and if the project is not successful, you may not get a cash flow. A convertible bond is a bond that can be turned into stock. So a company could put a convertible feature on a bond, and if it's obviously, let's say you have a bond, $1,000 bond, and it can be converted into $50, 50 shares of stock at say $20 a share. Well, the bond is worth, if the conversion is worth $1,000. Now what happens if the stock price goes up? Well, the bond price better go up too, otherwise there will be an incentive for you to convert this bond into stock. So having a conversion feature kind of puts a floor under the bond. A put bond gives the holder of the bond the right to give the bond back to the company. We talked about callable bonds. A call feature gives the company the right to demand that you surrender the bond. A put bond gives the owner of the bond the right to demand that the company take the bond back. So it works just the opposite. And many, many other types of provisions, and really what can't be added to a bond. It just depends on how creative you are and what is necessary out there in the marketplace. If you find a need for a product, you can offer it. The bond markets, bonds are traded in a market, primarily it's the NASDAQ, the over-the-counter market, where dealers are connected electronically. There are a very large number of bond issues, but the problem is most of them don't trade very often, so they're not very liquid, and sometimes it's very hard to get a price. Now the exception to that is Treasury securities, and Treasury securities are, there's so many of them. There are billions and trillions of dollars worth of Treasury securities, and they're maturing all the time. Every week of the year, the government is in the market selling Treasury securities. So there's not a week that goes by that there isn't a huge amount of, we're talking about billions of dollars a week that the government sells. So there's a lot of liquidity for these things. Now, Treasury securities are quoted in 30 seconds. So this is a little weird. Take a look at this. This is a typical Treasury quotation. First thing is, what's the coupon rate on the bond? Well, it's 8%. That's the first number. That second number, November 21, question is, when does the bond mature? Now that's not November 21st. That's November of 2021. And then the next question, what's the bid price and what does this mean? Now, there's a bid price and there's an ask price. Excuse me. And the bid price will always be lower. So if you look at 132.23 and 132.24, the bid is obviously 132.23. Now what does that mean? That means 132 and 23/32% of the face value. So if the face value is $1,000, you would take 132 plus 23/32% of 1,000. Excuse me. Same thing with the ask. Question, what is the ask price? The bid price, by the way, is the price that you would get for the bond from a bond dealer if you try to sell it. The ask price is the price you will have to pay for the bond if you try to buy it. And of course the ask price is higher than the bid price, and the difference between them is called the bid-ask spread, and in this case the bid-ask spread is 1/32%. The minus 12, that says how much did the bond price change from the previous day? Well, from yesterday to today the price dropped by 12/32, and that's the ask price that dropped. It dropped by 12/32, and then the yield to maturity on this bond. Now, since this is 132 and 24/32%, it's a premium bond. It's selling for more than 100% of its face value, and since the price has gone up, the yield to maturity based on the ask price is less than 8%. In this case, it's 5.14%. Now we talk about clean versus dirty prices. A clean price is the price of a bond that is selling exactly on a coupon date. Exactly on a coupon date. A dirty price is a price of a bond that sells between coupon payments. And so it's the price, the quoted price plus any accrued interest. Because after all, if you're buying a bond halfway through a coupon period, whoever's selling that bond to you has already earned half of the coupon payment, but they're not going to get it. You're going to get it because you're going to be holding the bond when the next coupon is paid, so you're going to have to pay a little more. So what we do is we take, here's an example, a Treasury bond. In the previous example, today is July 15th, 2005. The number of days since the last coupon was 61. The number of days in the period is 184. Excuse me. The accrued interest then is 61/184ths of 1/2 of 1 year's interest, or $13.26. And when you pay for this bond, you're going to have to pay the clean price plus the accrued interest of 13.26, or $1,340.76. Okay, we talk about the relation between inflation and interest rates. Obviously, interest rates include a real rate of interest plus an inflation premium. And so we talk about a real rate, which is a change in purchasing power, and a nominal rate, which is a quoted rate. And the nominal rate really includes the real rate plus an inflation premium. And here's the basic relationships called the Fisher effect. And it says 1 plus the real rate, 1 plus the nominal rate is equal to the product. 1 plus the real rate times 1 plus the inflation rate. Now there's an approximation. And the approximation says that the nominal rate is approximately equal to the real rate plus the inflation rate. And that approximation will be okay, provided that the real rate and the inflation rate are low. But you will find when you do your homework that you'll have to use the whole Fisher equation, none of the approximation. They want the whole thing done. So here's an example. If we require a 10% real return and inflation is expected to be 8%, what should the nominal rate be? Well, the nominal rate is 1 plus the real rate times 1 plus the inflation rate minus 1, or 18.8. Now, what's the approximation? Well, the approximation is 18. Now, is 18 close to 18.8? In interest rate world, the answer is no. 18.8 is nowhere near 18. 0.8% is a big amount of error in an interest rate. So it would be a mistake to use the 18 instead of the 18.8. What determines bond yields? Well, the relation between the time to maturity and yield to maturity is called the term structure. And it's important to recognize that in order to calculate the term structure, we have to control for anything that might be different. So, for instance, you couldn't calculate a term structure by comparing corporate bonds and treasury bonds because they have different default risk. You don't want to compare bonds that have different coupons. So you try to find bonds that are as much the same as possible, and then you look at what is the relation between time to maturity and their yield. Generally, what you see is that as interest rates, as maturities go up, so do yields, so do returns. So the yield curve is typically upward sloping. That's called a normal yield curve. Sometimes the yield curve is downward sloping, and that's called an inverted yield curve. And what that sometimes suggests is that the market expects a recession or expects an economic slowdown. Other factors affecting required return, default risk premium. Remember the bond ratings. The higher the bond rating, the more likelihood that the company will be able to repay and the less likelihood there will be default. Therefore, the higher the rating, the lower the default premium, and therefore the lower the yield. Whether the bond is taxable. Remember that if I'm selling a municipal bond, I can offer a lower rate because buyers of the bond aren't necessarily going to have to pay taxes on it. Liquidity premium. If bonds are traded more frequently, as treasuries are, then they'll generally have a lower required return. Basically, an investor who is looking at buying a bond that is traded infrequently is not going to be able to get out of that bond or even into that bond quickly and easily, and therefore they're going to demand a higher return to take the risk of having their money locked up in that bond. And anything else that affects rates and will obviously affect the risk of the cash flows. All right, so that pretty much summarizes things. Let's go through a quick quiz here. How do you find the value of a bond, and why do bond prices change? Well, the value of a bond is the present value of its future payments. And why do bond prices change? Well, they change because risk changes. They change because interest rates change. Maybe the default risk changes, and so on. What is a bond indenture? That's the legal contract that summarizes the terms of the bond, the size of the coupon, the yield to maturity, whether there's a sinking fund, whether there's collateral, and other important features, whatever the restrictions are. Bond ratings are an attempt by the private sector to measure the risk of bonds so that the rates of return can be adjusted. How does inflation affect interest rates? Well, the higher the rate of inflation, the higher the interest rate. Interest rates include an inflation premium. And what's the term structure of interest rates? Simply put, you control for everything else. You control for the risk, the coupon rate, and you just look at the relation between the time to maturity and the rate of return that you earn. And what factors determine the required return on bonds? Really, bonds can be affected by almost anything that affects the business of the company, the management of the company, can be affected by its competitors, can be affected by weather, can be affected by anything that affects interest rates, and that's almost everything. So many, many factors determine the required return on bonds. And that pretty much summarizes Chapter 5.